Hi everyone, just wanted to provide you with a special clients-only update on your portfolios, the market, and our current plan of action at the time. Last year's stock market decline in late summer, early fall, which was the first official market correction we'd seen in almost 4 years, caused us to sell a good portion of our stock positions in order to protect our portfolios from potential catastrophic loss. Since we call our money management strategy defense first, we care a whole lot more about not losing money than we do about losing opportunity. There are always new opportunities that we can take advantage of later, but if we participate in market crashes time and time again, there will be no money to take advantage of tomorrow's opportunities. By mid-September this past year, trends in the market were starting to point up again with few red flags, so getting out of the market for the most part during the correction created a lag in our performance relative to our benchmarks. But that's how our strategy is designed to work. There's no way to buy at the bottom and sell at the top. So by selling on the way down the hill, we participated in some of those losses, and by getting back in on the way back up the hill, we missed some of the initial gains, again, which created a lag. The market performed really well through October, but the rest of the year showed us nothing but negative monthly returns, which caused 2015 to close out as the worst S&P 500 pre-election year performance since Hitler invaded Poland in 1939. The end of December usually provides us with a boost in the stock market, something called the Santa Claus rally. Instead, the market was down about 2% during this time period, and the first 5 days of January was the worst start for the stock market in history, which was when we started selling investments in our portfolios again and throughout the rest of the month, which again ended up being the worst January for the Dow and S&P 500 since the early 1900s. Domestic stocks, or U.S. stocks, have fallen to the number 3 position out of 6 in our ranking system for the first time since 2011. Back then, they jumped right back into the top 2 in only a matter of weeks. This time looks much different than 2011, however. In fact, when comparing the relative strength between stocks, bonds, and cash, the red flags that are going up today have looked a lot more like 2002 and 2008, which is why we've largely gotten out of the stock market again. As I mentioned a second ago, we started selling stock investments out of all our portfolios again in early January, and between then and the beginning of February, we completely exited the stock market with the exception of 4 stocks that we still own in our aggressive portfolio and 2 in our moderate growth portfolio, all of which are still holding up well in terms of both strength and trend. Of course, if they break down, we'll sell them too. If you log into your accounts online or read your statements and notice that you still own investments, it's because you're largely invested in the bond market. First off, know that we don't buy individual bonds because we get tied up with maturity dates and a higher potential loss of principal if the bond market or interest rate environment were to drastically change between now and the next year. Secondly, understand that there will be days when the stock market goes up, which means that bonds will go down. This is normal. In fact, when the stock market crashed to the tune of more than 38% calendar year 08, 126 of the trading days that year were days when the S&P 500 was down, and 126 of the trading days that year were days when the market was up. So half the days were up, half were down, but over 1/3 of American wealth was lost that calendar year. The moral of the story here is don't focus on daily stock market movement. Longer-term trends don't look good right now, and we're not going to jump in and out of the market over and over trying to catch little bounces here and there. Also, don't mistake a few days or even weeks for a change in trend. Markets don't crash overnight. It takes time. At this point in 08, the market still had a good 9 to 10 months to go before it bottomed, and that was in March of 09, which ended up being a loss of more than 50%. So in conclusion, today, I see a lot more red flags and a lot more evidence of tougher times to come. Know that we've already implemented our strategy to exit the market as these red flags have popped up, and if we need to own bonds through the rest of the year, that's exactly what we'll do. If trends change and other investments such as gold, oil, gas, or any other investments start to gain momentum, then we'll start dipping our toes into those other investments as well. As always, if you have any questions at all, please contact our office via email or phone, or set up a time to come in and see us. If you forward this to any friends, family, or coworkers, that's okay. Just let them know that they don't have to be a client to ask a question. And finally, thank you for all your continued trust, confidence, and support. And as I always say, we wouldn't exist without you. I'm Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group, and I'll see you next time.